Yes, boss.
Hi, good afternoon.
Yeah, good afternoon. Sorry for keeping you waiting.
All right, okay.
Okay, can you remind me of what we did yesterday? Azam, can you
Yeah.
remind me of what we did? Yeah.
Sorry, I didn't get you.
Can you remind me of what we did yesterday, please?
Yeah,
Azam, can you hear me?
Yes, tell me. Sorry, I didn't hear you.
Yeah, I was saying that. Can you remind me of what we did yesterday?
Yesterday or day before yesterday we had a class.
Yes, they did. Whenever our last class.
Yes. Yeah. So we read about the basic concept of the fundamental. We come to know about the technical analysis. Those fundamental they affect the market movement, and also we learn something about the demand and supply for where the market moves.
Yeah, what else?
Um, I believe that's all. I think so. For the basic, we did half, and today we'll be going to finish the half. Yeah.
Okay. Okay.
yeah, bro, I'm here. Hello, bro.
Yeah, bro. I'm saying.
Yeah,
Let's
I'm
do a
here.
recap of what we did in our last class.
Okay, okay.
Can you
Yeah,
remind me of what you learned in our last class?
we talked about the basics. We talked about the fundamental activities, and you talked about the reasons why the retail traders fail because of the use of indicators and other things. You talked about supply and demand, and you gave us a brief history of why you're doing what you're doing.
Yeah.
Okay, so what lecture number are we on now?
That was 1.5.
Yeah, 1.5. I think factors that affect the value of exchange
Yeah.
rates in the
Yeah.
market, and the characteristics of big banks, institution, and novice traders.
Okay. 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 So we looked at the factors that affect the value of an exchange rate. So we're going to look at the characteristics of big banks and institutions, right?
Yeah,
Yeah.
Okay. So um, okay. So
Yeah. This is
the
for
forex
the.
market has what?
Yeah. This is the topic which we were last time. We ended here. Yeah.
So no, but so have we done this topic?
No. No. 1.5. Not yet.
Okay. Okay. All right. So this topic basically explains. the mistakes retail traders make and what makes banks and institutions very successful. So the forex market has a lot of participants, but can only be classified into two main groups, namely big banks and institutions and retail traders. Statistically, big banks and investors have very huge account sizes and are very consistent in profits. So the first fact we are establishing is that the retail traders have small account sizes. Big banks and institutions have huge account sizes. And also they are very consistent in profit. On the other hand, retail traders are not consistent in profit and they have relatively small account sizes. Now, these two groups of people are always match against each other. So why are big banks and institutions very successful and retail traders are not? This is because big banks and institutions they trade the financial markets differently. Despite their sophisticated algorithms and trading softwares, they are very patient and wait for price or a currency to become oversold. Now, when you say oversold, you're talking about cheap. Now, I told you when you go down the exchange rate, price becomes cheap. So that makes it favorable for banks to buy because they want to buy low. Or they wait for it to become overbought. When price becomes overbought, that means it's expensive, meaning that retail traders have pushed the price so high based on some news. All right. So what this means is that how you make money buying and selling anything in real life is the same way you make money buying in forex. In real life, we're all waiting for discount coupons and any kind of mechanism that will help us to buy low. So at the end of the day, why do we come to the forex market and we buy when the market's already going up and we sell when the market's already going down? Why do we do that? Because in real life, something is $10,000. You want to buy it at 8,000 or 7,000. But when you come to the forex market, to say something is $10,000, you want to pay 7,000. You want to pay 15,000 or 18,000. It doesn't make sense because when you wait for price to come expensive, then that means that you are buying high, and that is not how banks trade. Banks buy low and they sell high. So what we need to understand is that banks are very consistent in profits. Retail traders are not. Banks and institutions, they buy when the exchange rate is cheap, and they sell when the exchange rate is expensive. And retail traders will always buy after an uptrend and sell after a downtrend. Now, their trading account sizes are very small. That's the retail traders. While big banks and institutions have huge account sizes. Okay.
Yeah.
Yeah, correct.
That's the difference you need to understand. Banks always buy low and sell high. Now, the low and the high happens at major demand and supply levels, which we'll be looking at in the next level. But we're just showing you the mechanisms by which they trade.
Yeah.
Yeah.
Okay. All right. So that's just basically about the characteristics of big banks and institutions. Banks trade the financial market differently. Retail traders always, because they use indicators and chart patterns, they want confirmation. So price will always move up before they start buying or move down before they start selling. All right, let's look at trading as a zero-sum game.
Okay.
So trading is basically the transfer of money from one account to the other. Let us assume that an investor wants to buy one lot size of Euro USD. Now, if you want to buy one lot size at Euro USD, you need to buy it at a certain price, and that is 1.45705. So before the person buys, they need to be assured that the euro will appreciate. Am I right? Because You don't buy something that is going to depreciate. You buy something that's going to appreciate. So behind the scenes, the broker will match this buy order with a sell order by another investor who believes the euro will depreciate. So one lot size, remember, the calculation is one lot size is 100,000 units of the base currency. So when they click on buy one lot size, they simply placed 100,000 buy orders. And those 100,000 buy orders need to be matched with 100,000 sell orders for their transaction to be completed. If they do not get less than, if they get less than 100,000 sell orders, then the transaction is not going to be completed. So you need to understand that banks and institutions, they always struggle to fill their orders because they're always buying too much. But that is by virtue of their capacity. They have huge account sizes. Now, the banks that I'm talking about, they control world finance. Talking about banks with billions and institutions with billions of dollars in their accounts. The kind of lot sizes they'll be using are very, very huge. So now, when he believes that it's going to go up, then that's when he buys. Behind the scenes, the broker will match, I said, that buy order to a sell order. So now, let's say the exchange rate moves 1.45805. That's 10 pips. A one standard lot movement of 1 pip is $10. So that would be $10 by $10, and that's $100. So $100 would be taken from the seller's account. $100 will be taken from the seller's account and paid to the buyer. So when we say trading is a zero-sum game, it means the buyer's loss is the seller's gain, and the seller's gain is the buyer's loss. So when you make money, somebody has lost money. So what you need to understand is that banks and institutions, they are good at taking people's money because trading is taking people's money. So if you don't have the right knowledge in trading, you continue blowing your accounts till the end of the world.
Yeah.
So you need to have the right skills and understand how exactly buying and selling is done in the financial markets. Okay, so let's look at the order matching process, which is basically one of the most important engines of the beginner's course. Now, when we say the order matching process, we're just talking about a transaction that happens on a price chart. The process by which the broker matches a buyer to a seller.
Okay.
Do you get me?
Yes.
Yeah.
Okay. So typically, when someone is buying, they are buying at a certain price. So let's say in the Euro JPY market at a price of 117.29. You know, every buy order can be converted to the lot size. One lot is 100,000. So 200 buy orders can be converted to a certain small lot. Now, at the end of the day, what you need to understand is that the buyers will place buy orders, sellers will place sell orders.
Yeah.
So at the end of the day, let's assume that at this price, there is 200 sell orders matched to 200 buy orders. Let's just assume that 200 sell orders are matched to 200 buy orders. Now, you realize that there will be an order matching process. That's the first thing that you need to understand. You understand me?
Yeah.
There will be an order matching process. Order matching process. Where the broker will match one buy order to one sell order till all the orders are matched. So now, when you have 200 buy orders and 200 sell orders, that's an equal side on every on both equations. So 200 sell orders will be matched to 200 buy orders. Then you realize that 200 matched to 200, all will be filled. So they will leave behind no excess unfilled orders. So the exchange rate will move sideways. When buyers and sellers are equal, the exchange rate moves sideways. So filled orders are orders that have all been matched and there's no excess unfilled order. And that is not what is responsible for moving the market. What moves the market is unfilled orders. So field orders basically represent transactions that have already happened. Transactions that have already happened. But the thing is that big banks and institutions, when they are buying and selling, they find it very difficult to complete their transactions. So there will always be an imbalance. So when you want to buy, you need to buy where the bank is buying, and when you want to sell, you need to sell where the bank is selling. Let's look at two scenarios of field orders that create a demand zone and a supply zone. Okay. Okay, so let's look at how a demand zone. When you say demand just means buyers or unfilled buy orders. Supply just means sellers or unfilled sell orders. When you have 200 buy orders and 100 sell orders, you realize that there will be an order matching process. Whether it will move up or down, you don't know. What determines the direction of the market is the excess unfilled sell orders, the excess unfilled sell orders. Now, you need to realize that 100 sell orders will be matched to 100 buy orders. Now, after this order matching process, you realize that the 100 sellers will be exhausted and there will be 0 sellers, excess 100 unfilled buy orders. Immediately, this equation is true, 0 excess. Price shoots upwards. Now, why does price shoot up when there's buyers with no sellers? Because higher prices favors the sellers. So you have to go higher to find sellers and bring back to the point of transaction to complete the remaining 100 excess unfilled and buy orders. So on my Instagram, that will typically be my yellow box that I always draw. The yellow box is the area where the order matching process happens, and it acts as a magnet for price. Excess unfilled orders act as a magnet. What does it mean? It means that price has to come back. Price has to come back. It's by force. You have to come back to that level to fill those orders. There should never be orders in the market that are never filled. That's not the perfect market. There should never be orders in the market that are not filled. So we need to be careful about that.
Okay.
All right, so a demand zone is created by excess unfilled buy orders. Let's look at how a supply zone is created. Now, you have 100 buy orders and 200 sell orders. Obviously, the sellers are a lot. The sell orders are a lot. 100 buy orders matches to 100 sell orders. Now, all the buy orders have run out to 0. But there's still 100 sell orders. Immediately that happens, price will drop. Price drops from 117.29. It collapses from that price level, only to go lower because lower prices favors buyers. You need some buy orders to fill the remaining 100 unfilled sell orders. So price has to come back to that price level. That's why it acts as a magnet for price. So excess unfilled orders will always act as a magnet for price. Price has to come back to that price level, fill the remaining excess unfilled orders, and move. Now, if the amount of buy orders coming into the level with 100 sell orders is more than 100, it will break the level and move upwards. But if what is coming is less than 100, it will get filled and move back down. So that's what we need to understand. The order matching process is the process by which orders are matched and how demand and supply zones are created respectively. Let's look at price action analysis.
Okay.
Okay, so there are three types of market trends that you need to understand. The first principle here is that in an uptrend, buy orders are always more than sell orders. In an uptrend, buy orders are always more than sell orders. In the downtrend, sell orders are always more than buy orders. Now, a bullish trend is a trend that indicates buying pressure. And it shows that price has been moving up and up and up. So a correct bullish trend, you want to see momentum candlesticks. You want to see very large candlesticks leave the price level. Okay. A bearish trend shows that sellers are in control. Sell orders are always more than buy orders. Sell orders are always more than buy orders. Now, what we also need to understand is that there's a situation called a consolidation. Now, the consolidation is when the buy orders and sell orders are equal. And this represents the order matching process. So when you want to see on a price chart a level where transactions happen, because the way I am trading is I'm looking at the price chart, looking for areas where banks are doing transactions. The first thing that you need to understand is that you need to observe a brief consolidation and a momentum breakout, because when you have 200 sell orders, 100 buy orders, for a number of minutes or hours, demand and supply is equal, because when the 100 buy orders are matched to 100 sell orders, that's equal for a while before one side of the equation runs out to zero. So you want to see consolidation, because a doji is a candlestick that opens and closes not far from the open, or the open and closes are close, and it indicates buying and selling pressure is equal. So anytime there's a balance between demand and supply, you should see consolidated dojis. Immediately one side of the equation runs out to zero, you want to see a momentum breakout. So you don't go looking for breakouts from areas of consolidation. You have to listen carefully. People who trade demand and supply, they cannot always have the kind of accuracy that I have, because they are looking at everything on the price chart. I am not looking at everything on the price chart. I'm focused on big bank and institution demand and supply. Okay, and I'm telling you that when you have 100 buyers, 20 sellers, it will finish the 20 sellers very quick with a big imbalance of 80. But when you have 100 sellers, 100 buyers, sorry, and 80 sellers, it takes a long time to finish the 80 sellers with only 20 imbalance. So the greater the amount of excess unfilled orders, the stronger the zone. Now, you remember that 120 and 180, 120 fills quickly. So if you want to see price levels where demand and supply is very imbalanced, very, very imbalanced, price shouldn't waste time there. So the consolidation that you're looking for is brief consolidation. If you go looking for consolidation, you'll be confused as anything, because everything on the price chart is consolidation. You look for strong price movement and always move to the origin of the strong price movement. So at the end of the day, this is just the theory about price action analysis. So let's look at candlestick chart. Okay, so the kind of principles that I'm teaching are very, very simple. Those who can grab them will understand. Those who cannot grab them, the beginner's course is just to make you understand the order matching process and how demand and supply works in the market, mistakes retail traders make, and what big banks and institutions are always doing to be successful. Just a second, hold on. Candlestick charting, where we are looking at the parts of a candlestick. A bullish candlestick is a candlestick that shows buying pressure. Bearish candlestick is a candlestick that's showing selling pressure. Now, at the end of the day, a bullish candlestick has to close above the open. So it means that buyers and sellers are trading. All of a sudden, sellers run out to zero. So excess unfilled buy orders at the open price shoots price up above the open to close. So even a 15 minutes bullish candlestick, it means even before 15 minutes, there was an order matching process at the open price. And after, the sellers run out to zero, buyers short price up to close. That's one thing that you need to understand. And the second thing is that a bearish candlestick is a candlestick that closes below the open. And you need to know that the upper wicks indicate that higher prices are rejected. If a higher price is rejected, you have to shoot up and shoot back down. That's a rejection. A lower prices being rejected means you have to shoot down and shoot back up. So the lower wicks indicate that lower prices are rejected. Then for a bullish candlestick, you have the open price and the closing price. Then you have the real body. Now, what we need to understand is that bullish and bearish candlesticks at the open price, there's always excess unfilled orders. What makes the candlestick close above the open is the order matching process that happened at the open price. Sellers exhausted themselves, excess unfilled buy orders at the open short price up. That's one thing that we need to understand. Now, dojis are candlesticks whose open and closing prices are close. A doji is not indicated by how long the wicks are. That's not how you determine what a doji is. You determine what a doji is by how close the open and closing prices are.
Oh, okay.
How close the open and closing prices are. Now, if price opens and closes close to the close, it means that the force of demand and supply is equal. So then that means buy orders and sell orders are equal. So when you have a scenario like 1,000 buyers, 200 sellers, for a moment, demand and supply is equal. Yes, the time it will take 200 sellers to fill 200 buyers, that's an equality. Till one runs out to zero and there will be an excess. So that's what you need to understand. So when price is consolidating, you want to see doji candlesticks. Now, those doji candlesticks, I'm saying they represent the order matching process. Now, the momentum candlestick is just like any bullish or bearish candlestick, but the difference is that price shoots way above the open to close. The distance between the open and the closing price is very far. And for a bearish candlestick, the distance between the open and closing prices are very far. What you need to understand is that if Azam throws a stone and it goes 100 meters,
Yeah.
when I throw a stone and it goes 200 meters, I am stronger than him because my stone went further. So a candlestick that closes further from the open is stronger than one that doesn't close further from the open. So a candlestick that's 15 pips long is stronger than a candlestick that closes 9 pips long from open to close. So at the end of the day, when you want to see where banks and institutions are buying and selling, the logic is that because of their large volumes of buying, they create momentum candlesticks on the price chart, very long candlesticks on the price chart. That's how big banks and institutions trade.
Okay.
Okay, let's look at the fundamentals of demand and supply in a bit. But is everyone following me? Azam, are you following me?
Yeah, I do.
Yeah, I'm following you.
Azam, Mr. Pressure. Oh, no. Alan, Mr. Azam doesn't trust me.
Ah.
No, I do, but the session was quite late.
You should trust him.
I was quite holding myself, for a long time, to start, but
Yeah, Mr. Azam, do you know why Alan is on the class? Alan, the guy with you on the same class.
Yeah.
I'm giving him the class for free because he helped me with something. He gave me some information, someone was doing something bad with my account, and he told me, and I'm a good person, that's why I'm giving him my beginner's course for free. So when you don't hear from me, don't panic. Listen, people watch my YouTube video and they send me $1,000 and they don't even know me. You understand what I'm saying? I'm here to change the game and I'm here to be a good mentor. If you talk to any of my students, I have time for every one of my students. But you have to understand that there's a lot of pressure on me. I can say 3 o'clock and at the end of the day, we'll have class at 5. But don't get angry because, trust me, I'm the only one teaching order flow. And everybody wants to know because that is the right way to trade. Everyone wants to learn. So the pressure on me is not a joke. Next week, I'm launching my online school too. So I'm very, very busy with a whole lot of things. Understand? So don't worry. Anyways.
Okay.
Anyways, let's now you need to understand we've done almost 11 topics. Remember the order matching process and learn it. Now, the second thing I need to know is the law of demand and the law of supply. First of all, let's look at what the demand and supply curve is. The demand and supply curve of the forex market is simply the price chart. When you look at the price chart, this is the demand and supply curve. That's it. For Brent oil, this is the demand and supply curve. As you move higher, 73.03, 73, you see it will become expensive. When you move higher, it becomes expensive. When it drops, it becomes cheap. So higher prices favors the sellers, the condition to sell high. So why do you want to buy when the market is moving up? Yes, indicators, moving averages. They have to, when they cross head and shoulders, look at where they're telling you to sell. The neckline, but the downtrend started from the head. Indicators always get you buying after the trend and gets you buying and selling late because they lag price. That's one thing you need to understand.
Yeah.
Okay. So what you need to understand is that the demand and supply curve just simply means as you move up the price chart, the exchange becomes expensive and it favors the sellers. It doesn't favor buyers. Higher prices do not favor buyers. So when the prices are going up and you're now buying, you're a novice trader. Novice. When market is going down and you're now wanting to sell, then that means that you're a novice buyer. At the end of the day, I'm saying that there are two laws of the market that move the market. The law of demand and the law of supply. The law of demand and the law of supply. A demand zone is created by excess unfilled buy orders. So at a certain price, when you have 1,000 buy orders, 600 sell orders, order matching process. Till all the 600 orders are filled, excess 400 buy orders create a demand zone and shoot price up. It creates a demand zone and it shoots price up. Why does it shoot price up? It has to go higher. That's the territory of sellers. So now, watch this chart. It is going up to find sellers and bring back to fill the remaining 400. The 400 need to be filled with 400 seller orders. But the funny thing is that in an uptrend, buy orders, these buy orders are more than sell orders. So these sell orders coming in are still smaller than 400. So they get filled and an excess shoots it back up.
Okay.
That's it. It's a very simple process you need to understand. Very, very simple process. Now, you need to also understand the reverse for supply. Immediately, a buyer orders get exhausted because you see, in traditional technical analysis, they tell us you cannot predict the breakout. You are not God. It's only God that knows the direction of the breakout. So when there's a consolidation, allow the breakout to happen, then you can determine where the consolidation happened. Now, when there's 400 excess unfilled orders due to an order matching process, price shoots down. Price has to come back. It's a law. It has to come back to fill the remaining 400. When it's coming back, so basically candlesticks going up are carrying buy orders, candlesticks coming down are carrying sell orders. So now you're carrying buy orders to come and fill the remaining 400. Unfortunately, in a downtrend, sell orders are more than buy orders. So even if you're carrying buy orders, they are still smaller than the sell orders. So the excess will always shoot it down. Anytime there's an excess scenario created, the market moves in the direction of the excess. Sell orders is down, buy orders is up. That's what you need to understand. The law of demand says that when demand is more than supply, price should rise. Anytime there's another matching process and the sellers run out and there's buyers, price should rise. When you have 10 people selling iPhone and only 3 buy, only 3 selling, 10 people want to buy iPhone, only 3 are selling, sorry. 10 people want to buy iPhone, 3 are selling. Demand is greater than supply. Now, you have too many people wanting to buy from only 3 people. So now, they will say who has the highest amount of money to buy. That's auction. They will raise the prices. That's demand greater than supply. When supply is greater than demand, too many people selling, only few buying. Nobody wants to buy. So you have to lower your prices so that people can afford it. So the same laws of buying and selling in real life are applicable to the financial market or the forex market. Now, everything that we've learned, we're going to consolidate it in our last topic, which is a transaction between Goldman Sachs and Mercedes-Benz.
Okay.
Exactly. So let's look at a transaction between Mercedes-Benz and Goldman Sachs. This is to show you how big banks and institutions trade. This is to show you exactly how big banks and institutions, how they trade the financial markets. Okay, just a second.
I think the session is left for a minute.
Okay, so log back out and log in again.
Yeah, we log in again. Yeah.
Okay.
Okay, so we're just speaking about, we're going to look at the transaction between Mercedes-Benz and Goldman Sachs
Yeah.
in a bit. So now, big banks and institutions are very successful at trading forex. This is because they know the mistakes the retail traders make and trade against them to take their money. Retail traders always want confirmation, so they usually buy after an uptrend and sell after a downtrend. They always sell into major levels where big banks and institutions have their pending buy and sell orders. Big banks and institutions fill very large orders for their clients at their trade desks. Let us look at an example of how banks trade. Mercedes-Benz in New York saves with Goldman Sachs Bank and want to transfer $50 billion to Germany. Goldman Sachs must sell dollars to buy euros because you want to send dollars to Germany. So you have to sell your dollars and you buy euros. Now, do you think, would the bank want to buy the euro cheap or they want to buy the euro expensive? You guys should answer.
They want to buy it cheap.
Cheap. Yeah.
You sure?
Yeah.
Why do you think so?
Because they want to buy it at the least possible price.
Exactly. So they wouldn't. So banks do not use indicators. No bank that is successful ever uses. You know, indicators are not. They are just things human beings created. Somebody was just trying to understand, but that's not the real way to trade. It costed me $5,000 to learn how to trade properly. How many people can afford that? Or even if they can afford it, they wouldn't pay that to learn forex. So you have to understand that the way things are done is very different. Also, you need to understand that they want to buy the euro very cheap at a favorable exchange rate. When the buy order is placed, now, what I mean is that when the bank buys, there are two scenarios that will occur. Since the demand is 50 billion, it's either they'll get all the 50 billion sell or they'll get a part of it. Is that clear?
Yeah.
Yeah, yeah.
It's either they get all the 50 billion or they'll get a partial fill. Now, a partial fill means that only a part of it will be filled. You need to understand that 50 billion sell orders need to be available at that price to match all the bank's order. If they don't get 50 billion, their transaction is not completed. If you go to the market and they tell you that 10 apples for 3 naira, you don't pay 3 naira and go home with 7 apples. Your transaction is not completed. You have to wait for the remaining 3. That's the same here. When they want to buy $50 billion worth of euros, they need someone to sell $50 billion worth of euros. So now, let's assume that at that price level, there's only 10 billion. That's what's happening here. Demand is 50 billion, supply is 10 billion. You don't know what to happen. Order matching process. You realize that the sell side is not enough to completely match all the buyer side. So it creates an excess or an imbalance. So now that the bank wants to buy $50 billion worth of euros, the market only has 10 billion. So 10 billion will match 10 billion. Then you see there's an excess of 40 billion unfilled buy orders. Unfilled buy orders. What happens? Price shoots up. The consolidation is for the 10 billion. When 10 billion is matched to 10 billion, price stops and trades. Immediately there's excess, it shoots up. If there was excess on the other side, it shoots down. But this time it's buying, so it shoots up. To go and look for sellers to come back to fill the 40 billion buy orders still need to be filled. You need to understand that for a transaction to be completed, buy orders need to be completely matched to sell orders. So since you have buy orders left, it means that the transaction is not completed. Price has to come back to that price level to fill the remaining buy orders. And price shoots up because of the law of demand. So what you need to understand is that when banks and institutions are buying and selling, first of all, they buy too much, and second of all, they need all their transactions to be completed by getting an equal side of their trades. That is why when a bank wants to buy, they will do that on a bad news day. And when a bank wants to sell, they will do that when there's good news. Why do you think a bank will sell when the news is good? You ask yourself, are they mad? The news is good. Why are they selling? No. They have too many sell orders and they need to be filled with buy orders. And it's only on a good news day that retail traders push buy orders into the market. Do you understand?
Yeah.
So don't be surprised when Warren Buffett wants to buy Tesla stocks. Don't be surprised if that week they are saying shit about Tesla on the radio and on the TV. Yeah, it's normal. What Warren Buffett, when you go and you want to buy something from the grocery shop, the thing you want to buy is with somebody. He has to give it to you. So when Warren Buffett wants to buy Tesla stocks, the Tesla stocks are with human beings. You have to create panic so that they release their stocks. Do you understand what I'm saying?
Yeah.
Yeah.
So at the end of the day, they'll create false information. Tesla is going to crash. Tesla is not a good stock. It's all lies. So that people become fearful. They're not retail traders. You listen to news. So when you hear bad, you sell. When you hear good, you buy. Okay, cool. So now that the news is bad, you are all selling. You are pushing sell order. Let's say Azam sold 1 lot size. Allen sold 5 lot size. That's 6 lot size in total. That's 6 times 100,000. That's 600,000 buy orders. Let's assume Warren Buffett has 1 million. He needs sell orders to complete his transaction. So the banks always do the opposite of what you are doing. How many times have we seen good news, market shoot up, shoot down? Who shoots the market down? How many times have we seen bad news? The market shoots down and shoots back up. Who do you think is doing that? It's the big banks and institutions. They need the opposite of their trade. So that is the best time they can trade to completely match all their buy and sell orders. So we've come to an end of the beginner's course. So if there are any questions, let me know, or anything you want to discuss.
It was explanatory.
Yeah.
I don't
Always,
expect.
always, always.
I was in depth. Very.
Always. Always. So guys, that's exactly how the market works. That's exactly
Yeah.
Yeah, yeah.
All right.
yes.
Nothing from my side. All okay. It was quite good explanation. Yeah.
Yes. That's just about it. So since
This order flow, it works on all market, right?
of course, does the market have buyers and sellers? Answer that question.
Yeah, it does. It does.
Okay. So that's about it. So Azam, I'll text you a time for the next class. That will be, I don't work on weekends, so that'll be on Monday or Tuesday. So I'll text you the time.
Okay.
And I know you want it early, so because of the time difference, so I'll make sure that it's an early class.
All right. No problem. No issues.
All right. Thank you, guys.
Okay, Ross.
Yeah.
Thank
See
you.
you.